All right, I think everybody should be here. So just like to welcome everyone to another Learn It Live webinar. As always, my name is Thomas Atkinson. Today we'll be talking about Forex trading essentials. And I'm joined, as always, by Tyron Abella.
Hi everyone, welcome to tonight's webinar. So Forex for beginners, but with a couple of little bits and pieces that'll certainly get you up and trading pretty quickly. So we'll see how we go tonight.
Now, for anyone that hasn't been visiting our Learn It Lives on a regular occurrence, we will be talking about a trade we mentioned a few weeks ago, and Tyron will come up. We'll be talking about that a little bit later, but it's something where we like to follow up on what we're talking about when we are doing these Learn It Lives. We like to talk about the setups, how they're setting up, and then of course go back and look at what we have learned from that trade, whether it's been a success, whether it hasn't, and do the real live kind of trading technical analysis that we like to cover on this show. So just to get started, I'd like to go through the risk warning. The information provided in these videos has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. So what are we going to be covering today? Well, today we're going to be taking a look at what currencies are best to start with. I think it's a very common question that we get asked almost by everyone that we teach and train. We're going to be taking a look at building a trading system on a points-based approach, something we cover a lot on this show, but very, very important because treating your trading like a business is really the biggest rule to success. Then we'll be taking a look at what market conditions we look for. So this is another one we get asked for all the time, and it's something that if you teach yourself through trial and error, it can take a very long time to get good at, and it can also cost you a lot of money. So we'll be talking about that and making sure that we give you some tips there. And then finally, we're going to be taking a look at Metatrader tips and tricks. Now tonight we'll be covering Metatrader 4 still, but next time we'll do some tips and tricks as well on Metatrader 5. So we'll try to teach you a few things that you don't maybe know about Metatrader tonight, but next time we'll do Metatrader 5 as well, because a lot of people are starting to use that platform. So which trading pairs are best to start with? So as I said, we get asked this all the time, and I think a good place to start is always the majors. And when we mean the majors, that's usually the pairs against the US dollar. And you can actually search the major currencies in Google, and that will actually come up with, I think it's the Wikipedia page, and it shows you why they're called the majors. They're basically the currencies that are most traded on in Forex, and that means they're the most liquid, and they're often the most technical, aren't they, Tyron?
They are, yeah, definitely. So they're the ones you want to be watching, especially in the first instance, because quite often technicals play the major role in these ones. So a lot of, I guess a lot of the world's traders are looking at these major pairs on a very regular basis. So they're the ones that you really want to get involved in when you're first starting to learn how to trade.
What's often overlooked as well when it comes to currencies is that you want actually to be trading things that are traded by a lot of people, because if you're a technical trader, then you need other people to be also technically trading that currency pair. And I think that's a lot of people don't seem to realize that. And often we train people, we teach people, and they'll have a Norwegian kroner open or a Mexican peso or something else, and they'll be trading it heavily technically without understanding the fundamentals behind it. But what they don't realize is that maybe that currency pair isn't being traded as technically as the bigger pairs are, because the bigger pairs have so many technical signals. So it's always kind of better to be good at a few amount of currencies and get really good at them than be, just average at everything. And we'll talk about that soon as well.
There's always time to branch out to the cross currencies and more exotic pairs, but it's better to learn your craft, in the more refined currencies like the US-based majors and the USD yen, just the major ones there that we can see on the screen.
Another common thing about the US dollar pairs is that you do always have one consistency through it, which is the US dollar, and that's still a major. So until something changes, that's also great, because once you understand maybe even the basic interest rate principles behind the US dollar in terms of fundamentals, the technicals that you're seeing on these pairs may all be very similar, but you can then cherry pick or pick the one that's best for you and the one that's showing the best technical positioning for your trade. And another thing is, of course, gold and oil. This is a really kind of two popular commodities. Oil is incredibly popular at the moment. I think Tyrone and I were talking about this today. So do you have anything to say about oil or gold at the moment, Ty?
Look, the thing with gold and oil is, I find them at the moment. We were talking about it today that they are a little bit of they're in a bit of a holding pattern. You're really waiting for the market to move in either direction. We can see that the US markets are, kind of stagnating a little bit. They don't know whether they're going to go up or whether they're going to go down in a hurry. And you can see the commodities, the two majors being the oil and the gold, both sort of hovering around these levels. They've been, pretty consistent over the last, week or two. So they will generally move in the opposite direction, basically in the direction of the US dollar most of the time. So it's going to be very interesting to see what happens with them. But the world does watch them, and they watch them very closely. So, you can certainly include them in your basket when you are starting to learn the major currency pairs, because, they do move in correlation, quite a bit.
I guess you'd kind of call them the blue chip investments of or blue chip currencies of commodities, because they're the two old ones. There was a thing called the gold standard, which a lot of currency is based on originally, and of course oil has been a heavy trade for decades and decades and decades. It's such a big part of what underpins some economies around the world. So they're both very technical trades as well. And there's a lot of talk of course, oil going to potentially 100. I've heard that a lot. And you'll see, as Tyrone said, oil at the moment is kind of in that area where it's consolidating, potentially ready for a break to both ways. So that could be something that's interesting for somebody to start with, because it is a heavily traded commodity. Another one, indices, often overlooked. Indices are things like, in Australia, it would be the ASX 200. The ASX 200 is the top 200 stocks in Australia. And that's made up of literally the top 200 stocks, and that's all weighted against their market cap, so how big that company is. And indices are really great because, again, they're heavily traded, heavily technical, and I'd say that's probably one of our favorite trades, isn't it, Ty?
It is, yeah, absolutely.
Yeah, indices around the world are great, so often overlooked. So how do we become an expert quickly, even if we have selected some currencies? Well, even Warren Buffett didn't become an expert overnight. And I think that's very true. If you've ever read any of his autobiographies and stuff, he did a lot of research on companies. Now, he obviously looks at a different way, but he became great at looking at certain areas, and then he expanded his range. So it's better to be great at trading a few pairs than good at trading all the markets. Now, that means that if you get great at trading a few pairs, there's certain nuances and certain things that happen with currencies where if you're trading them at certain periods of the day, so in Australia, obviously, if we're trading the Asian session, historically, it's been a less market volatile kind of period. Whereas, as Tyrone says, after kind of we close and then London opens and then London meets New York open, that's often been one of the highest volatility times. So different strategies can sometimes work in those periods. And one of our favorite things used to be when we stayed up 4 a.m. in the morning, if I remember rightly, was to trade the New York late session, because it was very good at being able to scalp. Now, it's terrible for us Australians, but that was definitely something that was in the market, and we learned that the euro and the pound kind of slowed down during that period of time, and they allowed for a lot more scalpy kind of markets where you wouldn't see extreme volatility each way. You remember that, Ty?
Oh yeah, that was it was a very intense time, and look, we learned a lot doing that. Like, there's nothing wrong with spending a lot of the time, in front of the charts, even if it, means that you're going to put yourself out of your comfort zone if you're not in the right, I guess, time zone. But you do learn a lot from watching those markets move, and this is why it's actually quite important to really focus on only a handful of pairs being the majors at the start, so you get a real feeling as to what is normal and what is not, because it's really important to only partake in trading that you consider normal movement. You don't want to be, trading currency pairs or any instrument for that matter when it's behaving, violently in either direction, because yes, you can get wins and you can get, you can get quick wins in that time, but that's not really what, being a full-time trader is about. You really want to be going with the ebbs and flows of, healthy trends in markets. So it's more about actually avoiding the messy, volatile, noisy markets, and that's why understanding and having an intimate, relationship with with the pairs that you've actually decided you're going to follow, so you do know when they're behaving erratically.
Yeah, it's definitely the way to do it. I think we were talking actually at our workshop last week in Melbourne. We were having a discussion with some of the guys there, and they all came to the agreement that when they first started, some of them were trying to track news, some of them were trying to do certain things, and they were picking too many currencies, and they weren't good at any of them, and that actually ended up costing them quite a lot of money in their accounts. So it's something where if you do become great at a few pairs, often people in Australia, they love the Australian dollar, and that becomes something that they just get really, really good at. And the Australian dollar reacts to different bits of news as well. So you'll notice that Chinese news will impact the Australian dollar a little bit more versus some other bits of news even out of Europe nowadays. So it is interesting how economies and things, we've got to remember we're trading a currency of that economy. So it's really important that we get good at the way that news is interpreted as well in those currencies. So now that we've selected a couple of currencies, being hopefully the majors, indices, or commodities, those two commodities, how are we going to trade them like a business? So you'll see us bring up moving averages a lot in a lot of our webinars, and the reason why is they're just really popular and they're used heavily in the markets. And why is that, Ty? Why are they used so much?
Well, moving averages are predominantly the I guess one of the favorite indicators of most people, especially when they're starting out. And the crossing of moving averages is probably one of the most basic trading strategies there is. Now, we're going to show you a couple of little secrets on how to trade the moving average crossovers tonight, because if you traded every single crossover that happened, no matter what number it was, net you will end up down, because the market does get caught in what we like to call a ribbon effect, where they just continually cross up and down without really trending in any particular direction. But as much as they are a basic form of trading, they can be very powerful when they're used in the correct context. And by that I mean when you're trading in the direction of a trend and actually trading only the crosses that are wanting to trade in the direction of the overall trend. So we're going to have a look at a couple of examples here. We can see some of the more popular moving averages we've got on the screen here are the 5 and the 8 that we can see, the grey and the black, the 21, the 55, and the 200, which is obviously one of the most popular. Now, you'll notice that a lot of people might say, why 55 and why 21? We actually adopted the moving averages to Fibonacci numbers. So they replicate basically what a lot of people would consider the 20 and the 50, which are very, very popular moving averages in the stock market. But we like to adapt Fibonacci numbers because we find them just to be that little bit sharper. And Fibonacci, if you've done a lot of our webinars, you'll know that we regard Fibonacci numbers quite importantly for most of our trading strategies. So we have adopted our moving averages to suit. But in saying that, these could be easily 20 and 50 and 5 and 10, and you'd be getting very, very similar crosses in the direction. So does everybody can obviously see the green. We like to keep the colors fairly consistent on all of the charts that we use. So we can identify which moving average is what just instantly without having to change the colors or hover the mouse over them. Now, one of the most popular moving averages, and one I'd strongly encourage you to use if you are starting your trading journey, or even if you've been doing it for a little while, is the 21 or the 20 if you want to simplify it, because that's the one that seems to be the most neutral, and that's the one that price gravitates towards a lot. Okay, so you'll notice even in this downtrend that every time price has pulled back and had a bit of a pullback on its downward trajectory, you can see that it's always found trouble breaking that red 20 moving average. It's amazing, uncanny how many times it tries to bust above it, but actually continually goes down. And then down at the bottom, when it does eventually go up above it, you can see that it comes down and actually just about touches it on the way up as well. So the 20 is one of the most important moving averages, along with the 200. Now, the 200 is the most important because it's the one that you'll always hear about in the news. So if you're following any technical news or even some of the media on TV, they're always talking about companies or even the indexes crossing above or below the 200 moving average. So it's a very, very important moving average for a lot of reasons. But for the most part, it replicates basically half a year's worth of trading if you are using just trading days only. And a lot of people really gravitate to that in the stock market, especially on daily charts. So the 200s are very, very popular. And like we said earlier, you want to be looking at the popular trades, the currency pairs and indices, because that's what everybody else is looking at. So you also want to be using the most popular moving averages as well, because what everybody else is seeing is really what you want to be trading.
Yes, and that, look, we talk about this all the time. A lot of people say don't follow the herd. That's kind of true, not true at the same time. We do want to be like following the guys that are trading the big money, because they are pushing the market and they use these indicators and they use these basic things that we're going to talk about tonight in their trading. And therefore, when you see the go signals that says enter now, or exit now, a lot of people are going to be following that. And I think Tyrone brought up a great point. I'll just zoom this chart in over here. I've just added the 200 moving average here, and this is on a daily, and we can see how price has interacted with these moving averages. So one reason I wanted to bring in the 200 is I had a suspicion this would probably, I didn't even know this at the point, but I had a suspicion this was going to be a 200 moving average that's coming off. And you can see it hits that 200 moving average on the daily. This is the pound US dollar, so it's one of our majors. And look how it shorts or sells off that zone. So there's a reason why, because at the same time as it hits that 200 moving average, what it's also doing is it's coming back up and testing that previous kind of resistance zones over on this left-hand side. So the 200 moving average is an incredibly important moving average. And if we did see price come up, break through that, often what we will see at that point is we'll see the market go up and through and then come back and test or find support on that 200 moving average, because it's quite slow. So it's still going to be probably sitting around that zone if this was to occur. So 200 moving average, great thing for you to put on your charts. And if you are a beginner and you haven't put it on there, put it on there, start watching the daily interaction. It doesn't cross it very often, but when it does, it's very significant to the market. So another reason I had this pound US dollar up is I wanted to talk about this 21 and 55 that we've got down here. So what a lot of people will notice is that price, after it came off the 200, came back down. And often when you have this overlap where they're about to cross, these two moving averages are about to cross, that acts as dynamic support or resistance. So Tyrone, why is it so important to have, well, more reasons, but in this case, have two moving averages close together?
Okay, so for anybody who doesn't really understand how a moving average works, I'll give you a very quick example. If you're looking at the 20 moving average, let's just call it the simple moving average, all that is basically plotting the average of the last, if we're using the 20, we're using the last 20 candles, okay? So on a daily chart, it's going to basically count back the last 20 candles, last 20 daily candles, and give you the average of those candles, and that's where it's going to plot its price. So it stands to reason that when moving averages are starting to get close together, it means that price could be starting to change in a direction. So here we can see here that the red moving average, which is the 21, is just about to cross, it's kind of nearly crossed, but it's just about to cross the slower moving average, which is the 50. So the 20 moving average is always going to be faster than any number above it. So it's going to be a lot faster than the 50 moving average. And we make the red one the fast one because, just so for the simple analogy that red cars go faster than other colors apparently. So we always
and you always buy a Ferrari in red.
Well, that's why Ferraris are red. But we can always say that that's the faster moving average. Okay, so when the faster moving average is about to cross the slower moving average from below it, generally the market is already at a point where it's starting to turn. So we can already see here that we're starting to get a series of higher highs and higher lows. So we've already got some action to basically tell us that we're probably about to, start a bit of an uptrend. But when we get the cross to actually confirm that, we know that, there is a substantial, lagging indicator, I guess consolidating what we're trying to do. The faster moving average is getting there. It's rebounded off the 200. And we're going to expect that the next move is probably going to go up and retest the 200 again. But as Thomas said, the good thing about moving averages is that they are a dynamic support or resistance level, which means that unlike a static support and resistance level, which is just a horizontal line of where price has been before, either testing the upside or testing the downside, a dynamic level actually adjusts with what price is doing in its recent history. So in regards to the 20, that's why we like the 20 so much. It's using the last 20 candles to basically determine what the average price moves are. So that's why price respects it so much. As you can see, even in this example on the pound USD, as it was coming down, it respected the red line, which is a 20, all the way down. And now it looks as though it's about to be respecting it again on the way up as it's broken through. Okay, so when we're getting across of information being a dynamic support level and a static support level, we're basically getting double confirmation that this level is very strong. People who are trading the static line are going to be going in our direction, and people who are trading the dynamic line, which is the moving average, are also going to be trading in the same direction. And this is what we were talking about earlier, when it's okay to trade in the direction of the herd, as long as you've got a reason to actually do so, not because you're just following the herd, but because you actually have a solid reason to actually do that. And in this case, we've got a dynamic and static support to say that, yes, this could certainly go up from here.
So it's all about collecting as much information as we can to, I guess, create the case. And that's what Tyra and I always talk about. One thing I think we even missed when we first started is we kind of fell in love with certain indicators, or we kind of liked a few things, and we would only limit ourselves to potentially having just moving averages and maybe one support resistance, or we just use Fibonacci in indicators, or we'd use very little amounts of information. So the more information that we can get to, I guess, justify our entry, the better our trade should be, because more people are getting involved with that trade. And that comes back to, like what we said before, we want to use things that the big guys are using. If Goldman Sachs, if JP Morgan, if all those big names out there are using these particular systems, and they're using Fibonacci, they're using moving averages, they're using support resistance, and whatever else we can add to our business plan and our strategy, that's better for us, because that means that they're going to be entering into the market. And when they enter, they don't enter small positions, they enter large positions, and they add to those positions. And I don't think we thought about that as well when we first started. They are adding to their positions because they don't just go, let's add $1 billion into the market, because the market is huge, but they're not going to be able to just go buy $1 billion worth of Australian US dollar. They have to wait and add to their order as they're getting confirmation, because they do go often for the longer period. The shorter periods, usually robots, algorithms, those kind of things, general trade, but the longer period trades, it is about getting that case and therefore adding to the position over time. So with Fibonacci retracements, it's another one of our favorites. Ty mentioned before that we love Fibonacci, and we love using moving averages that kind of relate back to Fibonacci. But Fibonacci retracements are levels of support or resistance, where basically potential price retracements or potential price retraces before it continues in its prior trend. And this is what healthy markets usually do. Healthy markets retrace a little bit after a pull, up or down, and then they continue on with it. And we kind of think of Fibonacci a little bit differently to a lot of people. We really love the 38.2 and the 50, whereas a lot of people out there will say 61.8 is the golden number and it's great, but we really like 38.2 and 50. And I encourage anybody, if they haven't ever seen our webinar on Fibonacci, try to talk to your Pepperstone sales representative, and they should be able to organize you a link to that, because we talk about that in more detail. We just don't have tonight. But 38.2 and 50% are our favorite Fibonacci, and there's really great reason why. So how do we draw Fibonacci retracements? It's another one we get asked a lot about. Do we draw it from the wick to the wick, or the candle body close to the other candle body close? Tyrone, how do you answer this one?
Okay, so generally the thing with Fibonacci is, and it is a little bit of a problem explaining it to people who are just starting out, because it is a subjective thing, a little bit like how trend lines can work. Fibonacci retracements can be a little bit subjective, but what we have a general rule when we are measuring a swing high or a swing low, we always go from the absolute high to the absolute low, or the absolute low to the absolute high. Now, to give you a bit of an example of that, because it is, I mean, some people measure from the open or the close, or the top of the body or the bottom of the body, but it's better to take that subjectivity out of it and try and make it as consistent as possible. So as we can see, we're drawing a Fibonacci line here. See how we're going from the very bottom range of that swing. So when we're ignoring the body of the candle, and we're actually going from the bottom of the wick to the top of the top wick, which is right at the top of the 200 moving average. Okay, that way you're taking out any guesswork, and realistically, both Fibonacci's will work. It really comes down to how you want to draw it, but we always find that measuring the entirety of the move, which is the highest high to the lowest low, generally makes it the most accurate for the way we like to trade. So we always do it that way.
Yeah, so with this Fibonacci we've drawn here, we can see that of the last move, when it came back, it's come back and it's tested almost close to this 50% level. And this 50% level kind of is where we expect potentially the market to start finding dynamic support at the same point. So this is where we're starting to stack up a case for potentially buying the pound US dollar at this point here. And a lot of people say, oh, well, you know, we should have the entry point here. In trading, it's not exact. You're not going to always get the perfect entrance. I mean, it'd be great to scalpel the market and basically get the perfect entries all the time. But what you really want to do is you want to draw kind of a range that you're interested in. So let's say we drew a range from up here down here. This would be the range that we'd be looking at buying, and then we'd find as many reasons to potentially to purchase it here as possible. And that's what it's about. Even some people, they always say, well, I want to get the perfect price. Well, why don't you enter half of your trade at the beginning of your range and then half of your trade maybe at the middle of your range? And that allows you to be in the market. If it does come back a little bit further, then you get the market at a cheaper price. And then of course, you know, if it goes on and does it, that's great. And if it does what it does here, where it goes a little bit earlier, then you're still in with at least half of your initial risk. And we always, of course, recommend around 1% risk per trade. So that would be 0.5%. And it's great for your psychology. Being in the market is a good thing as well, because I know from experience and training a lot of people that if you see this and you've said, okay, this is the level I want to get in, there's nothing worse, is there, Tyra? And then seeing it go off, it makes 130 pips here, and you've missed out, but you did great analysis. That's the worst.
Yeah, well, it does happen a lot, and you can expect that to happen, especially as you're starting out learning the way to enter and exit, because a lot of the time these moves are going to happen probably when you're asleep. I mean, we've got a wide variety of people from different continents in here tonight, so yeah, some of them are going to be suited by the better moves, and some of them are going to be very disappointed when they wake up in the morning. But that's trading, unfortunately. But look, the good thing about trading the markets and understanding the signals and how the market works is quite often you will get a second chance at entry a little bit down the track. So we're always looking out for those pullbacks, and we're going to talk about role reversals shortly.
Yeah, so we'll talk about the final kind of element that we wanted to add, at least tonight, for a basic kind of trading system that actually forms or underpins a great trend swing trading system. So next up is what market conditions we look for. So non-farm payrolls, probably one of the key pieces of economic news that everyone knows about. It's actually a piece of news that we try to stay away from as technical traders. So often the Friday leading up to non-farms, basically nothing happens. And it used to be really bad. Like when we first started back in 2007 and 8, sometimes non-farm payrolls, I don't think the range on the euro used to be more than 15 pips. It was about that bad, wasn't it?
It could sit there between 15 and 20 pips, like for an entire day or even 48 hours leading into it, which is just, it's hard to even imagine that could happen now on something like the euro. But yeah, back then it was just, and when you're entering a trade with such a small amount of movement, you're really just sitting there and leaving yourself exposed to a market that, you're putting yourself at risk for really no gain, because I mean, if you're looking for under that pips in moves, then you're not really trading a strategy that's probably worth its weight, because ideally we want to be trading at least 1-to-1 or 2-to-1 trades. So 20 pip ranges are not going to give you very good entries or exits with the right risk management. So you're just not going to get the move. So you're leaving yourself exposed, for days with no real, movement in sight. So we're always looking to try to avoid those type of announcements, because the market does wait for it.
Yes, it certainly does. And you'll notice sometimes before non-farms, specifically before interest rates, a support or resistance will be being tested, or it'll be just like ranging just close to that support resistance. And the news will actually be the thing that breaks it either way, past that support resistance or going off another direction. So it's often worth waiting for confirmation, and that by confirmation we mean a candle that closes above or below that support or resistance before we potentially enter our trades. Another thing I'd like to discuss is Mondays. So I think it's become less of a thing, but Mondays used to be really bad for trading. In fact, in the mornings, if you traded, there was one day I remember we traded back in 07. This is a totally different broker back then, but it was literally I think 35 pips on the pound odd. So sometimes it used to get pretty bad. And that often used to be a day where you'd see fake outs. And what we mean by that is if we are in Australia or New Zealand and you wake up and you're trading that session, that's before the US or London has opened. And what that basically means is that the market may not have any direction yet because they are the markets that still direct what's going to happen in the currencies. So it can often be a day where you may want to kind of stay back, wait for the Tuesday, wait for the US market and the European market to have opened and done its thing, and then get involved. And it can often be a fake out. So we much prefer to trade the Tuesday, Wednesday, Thursday, potentially Fridays, than the Monday. And that's kind of good. You almost get a day off from trading, so that's not bad either. Another thing that we look at is time of year. I think this is probably one that is maybe less relevant than it used to be. There were certain periods of the year that you didn't necessarily want to be trading. Often around Christmas used to be really, really slow as well. I've noticed the last couple of years it's definitely improved in terms of the volatility. So there's been a lot more market moves. So time of year I think is probably less important. But yeah, it's still something that you can consider. And sometimes certain currencies as well, depending on holidays or time off and Chinese New Year and stuff like that, sometimes it can change the way that the market trades during that period of time. So that is probably instrument depending, but it is always important to think about that. So let's talk about the kind of final piece of the puzzle that we're using for tonight's trade, and that is role reversal. So we discussed this last week. We discuss it all the time because it's such an important concept. But for any beginner out there, role reversal is basically where resistance is broken by the market. So in this case, it would be an uptrend. And then that resistance becomes support. And I just jumped straight into the charts here. You can see an example there of a previous one. But let's jump straight into that pound US dollar, and let's take a look at the resistance becoming support. So what we'll notice is that this resistance over here was broken, took a little while. You can see that consolidation. There's a long leg doji candle, and that means actually the market was indecisive and didn't know the direction it wanted to go at that point. And then eventually it does break it, goes onto the 200, and then comes back and tests around this area. So when you see this kind of thing, what you're doing is you're adding extra reasons to be looking at our zone here. And if we bring up the US dollar yen from last week, and we were talking about this literally on the show last week. In fact, you did a few videos about it last 2 weeks, didn't you?
Yeah, so for anybody who doesn't follow our videos, we put out a video once every week on a Friday, just basically outlining what we think of the market or what's exciting in the market at any given time. And they're actually on our Facebook page. So if you want to go back and actually follow them, because you do learn little tips about what we're talking about tonight and how we actually interact with the real market doing the things that we're talking about tonight. And here we can see a perfect example of the USD yen following that the red to 20 moving average all the way up, and it's had a pretty reasonable climb up. What I will do, we'll just quickly show you, I've had a couple of questions here that I can see where people are asking how to put an EMA on the chart on the Metatrader 4 platform and the Fibonacci. So we'll just put another moving average on just to show you. All you've got
we'll
to
add
do,
the 100 here. So it's insert, indicators, we go down to trend, we select moving average, and then that brings up literally this screen here. So here we can select the type of moving average we want, whether it's exponential or simple. We'll use exponential for now. If you want to find out more, again, if you contact the Pepperstone guys, there is a video we've done on this. Then we'll just select 100, and what we can do is we can change the color. So in this case, we'll just make it yellow, and then that will add the 100 to our screen. And this will be 100 on any time frame. So what that means is if we go to daily, if we go to weekly, if we come back down to 4 hour, it will be the 100 on that time frame. So it'll be using that time frame, 100 candles. Yeah.
As you go through the time frames, the moving averages adjust the time frame that you're on. So the 200 on a daily, we'll use the last 200 daily candles, and the 200 on a 1 hour chart, we use the last 200 1 hour candles. So it does adjust automatically.
So this is a great example of literally us setting up a trade using these principles. before it even happened. So again, if you want to see it, it's on our Facebook page. We went through it multiple times before it did happen. So here's the US dollar yen. We can see here this clear resistance, and then that clear resistance has been broken and it's come back and tested it as support. And when this happens, we've also got, off the last move, a Fibonacci pullback at the same point. So 38.2, one of our favorites, which actually came almost down to the 50, and 38.2 on the same point as the roll reversal, on the same point as it hits at dynamic support. So we're starting to present a pretty good case for getting into this trade. And there's other reasons to get in on this one, but you can see just by using those three simple concepts, we've automatically made our trade a higher probability of success because we're using more reasons to be involved. And you can see that's actually what's happened up here. Look at this. Breaks to a new high, comes back, tests the previous resistance, becomes support, breaks to a new high, comes back, tests the previous resistance. It's the best, isn't it, Ty? That's a technical market. That's what we want to see.
That's a technical perfection, and that's what you want to see as a trader. We're not seeing a volatile market here. We're seeing a very healthy uptrend, and it's given us multiple opportunities to get into this trade. It's been a trading bonanza, the USD yen over the last, really over the last month or two.
Yeah, definitely one of our favorites, especially the last couple of weeks. So you can see that all comes together and creates a trading system. So let's just jump straight back into the slides quickly, and we'll talk about building a strategy. So basic strategy, I always like to use points. Why not use points? So in this case, if we had the simple moving average cross, or we had dynamic simple moving average support, if we had support resistance, which is that roll reversal, and if we potentially had the Fibonacci, we would have 75 points like we did that US dollar yen. The other thing we can add in there, and we haven't put it in tonight's slides because we just have limited time, is candle confirmations. So many people will know hammers and shooting stars. Some people will know engulfing. There's a whole bunch of different types of candle patterns out there. But if we add those four things together and we say we are not going to trade unless we have at least three of those things, so a minimum of 75 points, you can see how we're creating a replicatable system. And that replicatable system means that we can have success for a longer period of time and we can keep it consistent, which means we're treating it like a business. And I think most people out there will have a trading system, we'll use it for like 2 to 3 weeks, we'll have a couple of losses in a row, we'll give it up, we'll go on to the next one. I know we did that when we first started, worst mistake we ever made. Well, not ever made, but it's definitely a bad one. Maybe an overstatement there, but it's definitely something that's really important. So we love to build strategies with points. A lot of people laminate these things, they put them on their desk. I've heard of people literally doing that, then they get a Sharpie and they just basically tick it off each time. Some people have it on their computer and create a spreadsheet. It's all these ways you can deal with that. So one of the things at FX Evolution that we did was we actually did this and we practiced, I guess, what we preach, and we built our system, which is a Presic-based system, where it's a massive business plan, which takes into consideration many different reasons to be involved in the market. And we sometimes talk about this in webinars. We've also done it in workshops. It's very difficult to talk about it just in 40 minutes, but basically it takes into consideration price action, risk management, our ELD 363 system, chart patterns, indicators, and charting techniques. So it's very detailed and it's very well thought out. And it's basically a culmination of, I guess, our combined at least 10 plus years each of trading experience. So that's something that we do talk about, but it is a little bit too in depth for obviously tonight's session. So let's talk about Metatrader tips and tricks. One of them that I always get asked is how to find swap rate. How many times have we been asked that one, Ty? A lot.
Nearly every time I actually coach a new person when they're wondering why money's either entering their account or exiting their account once a day at the same time. It is pretty important, and we'll show you a very quick tip to find out exactly how you know before you even get into the trade at the moment.
Cool. So when you first open, you're going to have Market Watch most likely. When you've got Market Watch, we can right click on a currency, we can go down to symbols, and then we can see all of the currencies here. So if we want to check the swap for US dollar yen, we can then click properties. It'll bring up this little kind of window. And if we scroll down, you'll see a swap long and a swap short. And what that means is if we bought the US dollar yen right now, it's actually a positive swap. So for every contract we buy of this, so one lot, we would actually get given money each day. And that's pretty cool. But that doesn't mean you should track it like that. And then, of course, if we shorted it or we sold it, we would lose a little bit of money each day. And generally, you'll find the positive swap is less than the negative swap, but that's how we find it in the Metatrader platform. So very common question we get asked, really important to look at. Another one is show all currency functionality. So a lot of people have this screen up here, and then they can actually right click on it and again left click on show all. And what that does is it gives us all of the current currencies that are available in the Pepperstone platform. And sometimes, I remember when crypto was pretty big last year, Pepperstone was adding a few different crypto currencies, and they were showing up, and I said, Ty, Ethereum's here and other things. So at the time, I didn't even have it on there, and then I right-clicked show all, and then all of a sudden it rocked up. So it's always good to do that every so often. I do it like once a month, just in case if I've missed an announcement or something. So that's always good. Another one, creating templates. So another thing that people don't often do is they don't know that they can right-click on the screen, create a template, and then basically save that template. So then we can load and save it and keep it like the screens all the time. So when we load up heaps of different screens, we can then right-click, we can go down to our template, select, let's say, Pepperstone template, and it will clean up our screen and bring it back to the way that we like it. So we'll probably do a day where we do literally just Metatrader and we talk about that, but that's another one that a lot of people like. So it's pretty cool to look at. And you can access it up here as well. Anything else, I guess, you want to mention quickly there, Ty?
Yeah, just I see a question here. It's saying is it possible to group currencies to open in a multi-window? I'm assuming that you're talking about getting charts or like multiple charts on the screen, but we can certainly show you how you can load up, how you can break the charts down on. So if we go to the tab, we'll have a
Windows tab.
Yep,
we can go to tile windows, and basically that will tile the ones that we've got open down the bottom. So if we open up a new chart, let's just say US dollar yen, we'll right click, create our template, and we go, oh, that's not very good, we don't like that. So let's tile all of them, and you can see it puts it in a really nice 4 window there for us. So rather than us having to collect it, move it, bring it down. I know we did this, and I remember doing this back in the day. You can actually just click on window and then tile windows and do it the way we want to do it.
Yeah, and the good thing about a template is, we do encourage you to try and keep the color schemes as close. It doesn't matter what color everything is, as long as you understand and attribute whatever color everything is to the right thing. So we always like to have our candles and bars the same color across all of the pairs that we're looking at. I know some people like a bit of a different color combination. That's fine as well, as long as you know exactly what everything means in a first glance. You don't want to have to be referring back to know what color a moving average is or what you really don't want to be doing that, because trading, the whole idea is to actually have a quick view and see exactly what is happening in an instant, rather than trying to work out what every color means.
Yeah, exactly. Another thing is a lot of people actually have started using black screens, and there's a good reason for that. And when you're looking at the charts for a long period of time, especially if you're more of a scalper, you actually can get pretty sore eyes from the white screen, especially if you have more than one. So I think in our office we have a lot. In fact, the office Ty is sitting in right now is a lot of screens. So sometimes having the black screen's not too bad either. One thing I'd just like to kind of end on before we ask questions or go to the questions, and by the way, if you have questions, please put them in the chat now and we'll try to answer as many as we can, is sound risk management. So always try to be smart with your risk reward strategies. Try not to risk over 1 to 2% of your capital. You can build quite quickly by the power of compounding. So do remember 1 to 2%, it's a golden rule, everyone says it, they say it for a reason. And then your risk reward is really important. You need to be aware that when you're placing a trade, obviously you'd love to have, if you risk $100, you should be looking at least trying to get $100 back on that trade, if not 150 to 200, if it's there. You shouldn't be looking at, a 0.5 to 1, so where you risk $100 and you only make 50 back. And I think a classic example of that is if we go to that pound US dollar, we look at the daily. If we were, let's say, involved in this trade for whatever reason, and we were buying it here, we'd probably be able to be broken even by now. But let's say a realistic goal would be maybe 80% to the peak up here. Like Tyrone said, it may go back and test this 200 moving average. So a realistic goal for that trade is probably around this point. But an unrealistic goal is probably to say, oh, I think it's going up here. What makes you think it's going up there? There's no confirmation it's broken to a new high, those kind of things. So you need to be realistic with your risk rewards. It's very, very important. I think we'll leave it there and go straight to questions. So do we have any questions that have been, I guess, asked during this webinar? We'll hand it over to Pepperstone, guys.
Hey guys, yes, we do have a couple. So firstly, going back to the moving averages. So
Sure.
I guess it's a lagging indicator. When would you say the right time to get in is? Because obviously when it does do the cross, you're technically too late. So when is kind of the best time to kind of think about getting into the trade?
Yeah, so it's a good question. It comes down to, like what we just said about that dynamic support resistance. What you'll notice about our trade there is that it actually hadn't crossed yet. But what had happened is price had crossed above. It hadn't crossed, but price had crossed above, and we found the roll reversal, which is this point here, and we found the fib, and we found the dynamic support. So that gets you ahead of the rest of the guys in the market. As you said, or as that person said, when it crosses, maybe a little bit too late. So by using it as dynamic support or resistance and bringing in those other reasons, using price action, we can be above or in front of the market. So that's just one classic, I guess, way of looking at it.
Good stuff. And in regards to indicators on a whole, how many indicators would you say you should have on your chart before it's either too many or to verify the trade?
Sure. So another one we get asked all the time. We have done some webinars on this. I'm sure we'll do some more in the future. Try not to use too many indicators. A lot of indicators, let's say like an RSI and a stochastic, they'll often show you very similar results. So what we used to do is we used to have like 3 or 4 indicators like that on there, and they were all showing us kind of, they were some of them were agreeing with each other. And what that meant was we went, oh, okay, well, they're agreeing with each other, let's place the trade. But what we didn't realize was they were being formed of very similar kind of reasons, and they presented the same kind of trades. So you don't want too many. In fact, you'll notice that
we thought we were getting more
system,
we thought we were getting more confirmation, but in fact they were just doubling over the same information really, and it just wasn't giving us more. It wasn't giving us more information. It was giving us much of the same. So that's why it's important to take elements like we talked about with the points-based system earlier, using different elements from the indicators, chart patterns, support and resistance. When you combine those sorts of things, that's far more powerful than having too many indicators on your screen.
Yeah. Any other questions we've got out there?
Yeah, I know you briefly touched on another seminar in regards to the moving averages, but would you be able to just briefly explain the differences between the simple one, etc.?
Sure. Okay. So with the simple moving average is basically a direct average of the number that we're talking about. So if we're looking at a 20 simple moving average, it is the direct average. So it basically adds up the movement of the last 20 candles and divides them by 20, and that gives you your plot zone. Whereas the EMA, which is the exponential moving average, that gives more weight to the front numbers. So assuming we're still using the 20, it gives far more weight to the last or the first 2 or 3 candles that you see on the chart. And as the candles go back from, say, 16 all the way back to candle number 1, going in the other direction, the weight gets less and less, which means that the EMA is a little bit more responsive because it's using the front candles, it's front loaded to actually give the plot zone. And as much as that's good to get you in trade, sometimes it can also get you into a little bit of trouble because it's also the fake out EMA, if you like. So when you those signals are often where you might get a little bit of a fake out because they are a little bit quicker. So the simple moving average is a little bit more steady. The EMA is quite a bit quicker. But in saying that, for all of the smaller moving averages, we do use the EMA because we do like its responsiveness.
Cool. We got any other ones out there?
There was just one more on the Fibonacci, just to go over it one more time on the importance between the exact numbers.
The exact numbers in terms of the different fibs?
Yes.
Oh, okay. I'd probably say that it's best for us to maybe refer people to our video on that one, because we do go over why. But when you think about it, effectively with Fibonacci numbers, it's really just a percentage of pullback. So there's a 23.6, a 38.2, a 50, and a 61.8. So if we're thinking of a 100 pip move, if it comes back to the 23.6, it's 23.6 pips back. If it comes back to the 38.2, it's 38.2 pips back. The reason we really love 38.2 and 50 is because if you had a 100 pip move and it comes back up to 50% of the way, psychologically people are like, bargain, let's get in, that kind of thing. Whereas when it starts to pull back a little bit too far and it goes at 60%, or that's 61.8 pips, is it really a strong trend? Is it really going in that direction? There are people that actually will now be like, oh, it's pulled back too much. I think it's going in the other direction, because on the smaller time frames, it will be going in the other direction. So we really love, there are other reasons, but we really do love the 38.2 and the 50. I think that's probably the best answers that. And I noticed, I think Mark said something about our risk reward. So yeah, if it was written wrongly, that's our bad. But basically risk reward, you always want to be obviously getting rewarded for more than you're risking. So that's what we do mean.
Yeah, we do that because like some people like to say risk reward and some like to use the reward risk. So we actually change it up to suit both. But the bigger number is always going to be the reward and the risk is always going to be the smaller number, whichever way it's written. So yeah, just be mindful. Your winners should always be bigger than your losers.
That would definitely be the way you want to go. I don't think Warren Buffett has bigger losers than winners. Okay, so just wanted to quickly end up tonight just by letting everybody know that if you are in Melbourne, we do workshops. We do free workshops. We had a couple of people attend last week, or a bit more than a couple, and they really loved it, and we loved helping them out. So that was a great session, and you can just come to our website, fxevolution.com, and click on workshops, and we'd love to see you there. Also, we will be doing a kind of like weekly or bi-weekly kind of webinar as well, just if anyone wants to keep coming and go in the off weeks between the Pepperstone stuff, which would be great. So
we're actually doing one next Wednesday at the same time at 7:30. So if you'd like to come along to that one, just pop into our website and click on workshops and just register your details, and we will send you an invite link to that one. So what we'll be doing is looking at the markets as they are at the time, and seeing what live action is happening and how we can apply some of our techniques that we've learned tonight and some others into the live market. So yeah, it's going to be very interactive.
Yeah, it'll be really good. So really thank everybody for coming out as always. Love doing these things, love working with you guys, and hopefully you enjoy it. We love imparting some of the knowledge that we've learned over the years, because it was definitely through the blood, sweat, and the tears, if you can say that, sitting in front of a computer screen. I feel like there was blood, sweat, and tears. But yeah, thanks everybody. Hopefully you enjoy your trading journey, and we hope to work and see you guys soon.
Yeah, we'd love to see you next week. Thanks, guys.
See everybody.